Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 28th of August. I'm Daniel Lam, your host for the podcast. Today, we will dig deeper into Jay Powell's Jackson Hole speech last Friday. Across asset classes, there was some volatility during the speech, but ultimately, the US dollar, US 10-year Treasury yields, and the S&P 500 all ended up relatively unchanged for the day. It showed that the speech was quite in line with what the market was expecting, i.e. the Fed is keeping open the possibility for further tightening, and Powell, at the same time, would like to dampen expectations of early cuts. Let's look at the key quotes from the speech. On the inflation front, Powell reiterated that it remains too high and that there is substantial further ground to cover to get back to price stability. He highlighted that policymakers are attentive to signs that the economy may not be cooling as expected, and that additional evidence of persistently above-trend growth could warrant further tightening of monetary policy. And lastly, he stated that 2% is and will remain our inflation target. On the policy outlook, he said that the process of bringing down inflation still has a long way to go, and the Fed is prepared to raise rates further if appropriate, and intends to hold policy at a restrictive level until it is confident that inflation is moving substantially down towards its objective. And Powell concluded the speech by underscoring that the Fed will keep at it until the job is done. So overall, this is a moderately hawkish speech, and it suggests that unless there is meaningful deterioration in the economy, a pivot to rate cuts is not imminent yet. So this suggests that investors are well advised to be playing defense and keeping calm. For example, it is worth doing reallocation amongst the US sectors, such as rotating into the more defensive healthcare sector, which is high quality, reasonably valued, and may outperform the broader US market. Healthcare earnings growth has remained positive even during recessions over the last 2 decades. It is also worth adding to US Treasuries. With US 10-year yield at 4.3%, we're now facing heavy resistance at the 4.5 to 5% yield areas. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.